I'm joined today by James Hill, who is a partner in our tax department here in the London office of Mayor Brown. James, welcome. Thanks very much for joining us.
Thank you.
I'd like to start today by asking you the question around the past few weeks. There have been a lot of changes going on in the tax world. Can you talk us through what some of those have been?
Well, probably the key change from a corporate perspective is the change that was announced a long time ago, which is the change in corporation tax rate from 19% to 25%, which is happening in April next year. So that was announced a long time ago and then cancelled and then reinstated. But that's really the most important change that's happening. There are some other minor changes in relation to transfer pricing documentation, for example, or in relation to the diverted profits tax rate or the taxation of energy companies. But the main thing for most corporate clients is the tax rate, corporation tax rate going up in April.
And what about personal taxes?
Well, for personal taxes, the new Chancellor did announce some changes in the autumn statement. He didn't change the rates as such, but what he's done is he's changed the allowances or the bands in which you pay different rates. So one sort of headline change was in relation to the top rate of income tax, which is staying at 45%. That's now going to be paid for people earning above 125,000 instead of 150,000. Similarly, there's a dividend exemption for individuals. That's going to drop, so the amount you can earn and be exempt on dividends is going to drop from 2,000 to 1,000 next April. And another change was in relation to capital gains tax. So for capital gains tax, you have an annual exempt amount. It's currently 12,300. That's dropping to 6,000. So effective increases in tax without changing the rates.
And there was a lot of speculation recently in the press about the so-called non-dom rules. They haven't changed, have they?
No, not really. There was only really one change in relation to non-doms. It was a source of speculation, I agree, but there's only really one change, and that's in relation to the share-for-share exchange rules. It's a very technical change. It's broadly aimed at stopping non-doms changing UK shares for non-UK shares. So what it's going to say is in those circumstances where this new rule applies, the non-UK shares will still be regarded as a UK situs asset, which is an important point for non-doms.
And I understand after the change in Chancellor and also Prime Minister, the IR35 legislation was also left alone.
Yes, that's right. I mean, there was a very important change announced by our previous government regime, but that was unwound, and that's in relation to IR35. So IR35, just by way of reminder, is the regime that applies to workers who are not employees in terms of employment law, but they're taxed as employees. So the basic premise is that where a client is engaging a worker and there's some sort of intermediary in the middle, usually connected with the worker, so it might be their personal service company, for example, then the tax rules apply as if they were in fact an employee. There was a very important change to those rules which came about for public sector end user clients in 2017 and for the rest of the economy in 2021, which was to shift the burden of paying PAYE and national insurance from that intermediary, usually a personal service company, to the end user client. So those rules are staying, and that's still an important issue for engaging workers who may not technically be employees.
And is that the key concern for employers, where it's unclear what status their workers, those people are employed or self-employed, what that status is?
Well, sadly not. I mean, there's lots of issues associated with that, of course, employment law rights as well as tax issues. And with the gig economy, that's just an important issue that's becoming increasingly important.
And you said earlier the key headline for business is the planned increase in the corporation tax rate. Does that make any difference to the attractiveness of this jurisdiction for foreign investment and foreign businesses?
I think that remains to be seen. There is a change in the corporation tax rate which will make, tax bills go up for certain corporate taxpayers. But for other types of UK corporation, so for example holding companies, it won't actually have much of an effect, I think.
And why won't that have the same effect for holding companies?
Well, we have a good holding company regime in the UK. So a holding company is generally exempt from gains that it may make under our substantial shareholdings exemption. It's generally exempt from dividends it receives from its subsidiaries. And also it can pay dividends without any withholding tax in the UK. So we have this, this very good holding tax regime in the UK. So for a holding company that isn't subject to tax anyway, an increase in the tax rate doesn't really matter.
Is the UK, in a general sense, an attractive jurisdiction for non-UK companies?
Yes, I think so. From a tax perspective, it is. I mean, despite the recent changes we've had in the government, the UK tax regime is relatively stable. And in recent years, there's been lots of consultations which have been opened by the government in relation to tax changes, major tax changes. And that consultation system, generally works quite well.
And how does that work?
Well, it usually takes a number of months, weeks or months, and some draft legislation will be published. The government won't always take into account every comment that's made in relation to proposed changes, but the system helps to iron out unintended results or unexpected side effects. So it's a pretty good system in relation to new legislation.
James, thank you so much. My final question for you is, what would be your key takeaways for any clients who are watching today?
I think, well, as the economy's turning and companies need to consider their debts, one point always to remember is in relation to debt restructuring. The basic rule for tax in the UK is that the tax position of corporates will follow their accounts. So if you're doing anything in relation to debt which is going to generate accounting profit, that may cause taxable profit. There are ways around that. There are things you can do that can prevent taxable profit arising. A debt for equity swap, for example. But the main takeaway, I think, is if you're starting to think about debt or changing the terms of your debt, you should always consider that from a tax perspective as well as in relation to the corporate law.